Hi everyone, good to have you here. This is A Plus Academic Resource Center. Thank you for joining. Thank you for the shares. Thank you for the subscription. Thank you for like and everything. Okay, you support us to do more. You encourage us to do more. All right. Okay, so in our TikTok page, we have done some introduction. Okay, so this is the full class. Okay, we're going to be understanding what these end of year adjustments are. These various adjustments. Okay, we're going to be understanding them in full details. Okay, now when we talk about end of the year adjustment, when the trial balance is being drawn up, okay, for the purpose of final accounts, okay, now it is necessary that some adjustments be made, okay, or let's put it this way, some transaction or some entries must have been made, or some transaction must have been made before the trial balance was extracted. Do you get that? Before the trial balance was extracted, there were some transactions that may have occurred or transpired in the course of normal business before the trial balance was extracted. So it is necessary for you now as a bookkeeper or an accountant to adjust for those transactions, okay, so that you can have an accurate final account. If you don't make those adjustments, you may either inflate the figures of your entries in your final account, or you bring them down totally. You will not have an accurate entry and an accurate figure. Do you understand that? So it is necessary for you to make those adjustments. And for examination purposes, those adjustments are usually added at the footnotes or additional information. I'm going to share a typical example so that you see what I'm talking about. When we say additional information or footnotes, these are information that comes after the trial balance, okay? After the trial balance, they are additional information. So for examination purposes, those information you see in the footnotes or in additional information, they are those adjustments. And you must provide for them. You must make them up. You must treat them for you to have an accurate final account. Don't just work with what you see on your trial balance, because some of those additional information are somehow connected to those information in the trial balance, and we are going to see that here now. Okay, all right. Number one here is closing stock. When we say closing stock, these are stock that are remaining or that remain unsold before the trial balance was, or after the trial balance must have been drawn up. Okay, after the trial balance must have been drawn up, these are stock that remain unsold, and you will always see them in additional information. So this is how you treat them. Now, before I go further, hear this. These are accounts of a final accounts of a sole trader. We have what we call the statement of profit and loss. Statement of profit or loss and comprehensive income. Statement of profit and loss. I don't want to wipe the board off, okay, so that we'll be working with this one after the other. Now, just pay close attention, okay? We have what we call statement of profit and loss and comprehensive income. Then the second one is what we call the financial position. Now, before now, it used to be, or we do call it, trading accounts, trading, profit or loss account. That's the old name. Trading, profit or loss account, okay? Then the financial position used to be called balance sheets. Hello? Used to be called what? Balance sheet. But now, the International Financial Reporting Standard has upgraded so many things, okay? So what we call it now is statement of profit or loss and comprehensive income, okay? Then the balance sheet is known as the financial position. Are we together? Okay, now for example purposes again, listen to this. Those information in the additional information or footnote, yeah, they must appear twice. They must appear twice, either in the statement of profit or loss and comprehensive income, or the financial position. They must appear twice. This is what I mean. For closing stock appears in statement of profits or loss. Okay, you deduct closing stock from cost of goods available for sale to get your cost of goods sold. Okay, so closing stock appears in statement of profit or loss. Okay, it also appears as current assets. Okay, current assets in the financial position. Do you get that? Current assets in financial position. So it's appearing two places now. It's appearing in the statement of profit or loss, and it's appearing in the financial statement of financial position. So typically, for example purposes, I'm giving you this clue now. Every information in the additional information or footnote usually appear twice. All right, the second one is prepayment. Prepayments are payments made in advance for a service not yet enjoyed. Do you understand? You have paid for something in advance. You have not yet enjoyed it, but you have paid for it in advance. Okay? That's what we mean by prepayment. Prepayment, that is payment in the future. Okay? Now, we have prepaid expenses. These are payment for something you have paid, you have for services you have not yet enjoyed, but you have paid for it. Okay? While this one, prepaid income. These are income, services that you have not yet enjoyed. Okay? But you have received more, you have not yet delivered. Services you have not yet given, but you have received money for it. Am I making sense? Let me come again. When we say prepayment, these are payments in advance. Payments or income in advance. Okay? Now we have prepaid expense. Prepaid expense are you have delivered a service. Okay? Sorry, you have not yet received a service. You have not yet received a service, but you have paid for it in advance. You have not yet received a service, but you have paid for it in advance. Why prepaid income is you are yet to receive a service, but you have received money for it. You have received money already, but you have not delivered. That's what we typically mean. Do you understand it? So prepaid expenses, it will appear in statement of profit or loss and comprehensive income. How do you treat it? You add it to the expense that is noted in the trial balance. Okay, sorry, you deduct it from the expense that is noted in the trial balance. For instance, if I say prepaid expense of rent in the trial balance, let's say we have rent of 20,000 naira and the prepaid expense there is 2,000. So in your statement of profit or loss account, you what? You deduct 2,000 from that 20,000. Are you with me? Are we together? Then under statement of financial position, you what? It's a current what? Asset. It's a current what? Asset. Now we have prepaid income. Prepaid income, these are, or you call it income in advance, income received in advance. Okay? These are income not yet due, but you have received the money already. Okay? These are income not yet due, but you have received it already before, as at when the financial statement or financial position was stated. Okay? Now, this is how you treat it. In the financial profit or loss account, you deduct it from the income stated in the trial balance. You deduct it, okay? While in the financial position, it is treated as current liabilities. Are we together? It is treated as current liabilities. Do not worry, just follow me, okay? Follow me. By the time we begin to solve a question, you will understand it better. Now we have accrued expenses. Now, accrued expenses are expenses. You have enjoyed the benefit, okay? You have enjoyed the benefit, but you are yet to pay for them. You have enjoyed the benefit, but you are yet to pay for them, okay? So we have accrued income. These are income that you have rendered the services already, but you are yet to receive the benefits. You have rendered the services already, but you are yet to receive payment for it. These are accrued income, owing. Somebody is owing you money. You did something for somebody, and the person is yet to pay you. That is accrued income. While the accrued expense are something you have enjoyed the services already, but you are yet to pay for it. Okay? Now we have the bad debt. Bad debts are when we say bad, something is bad, it's irrecoverable. Okay? Bad debt is irrecoverable. Now, in the trial balance, when the bad debt is stated there in the trial balance, okay, you just treat it as expense. under the profit or loss and comprehensive income. Okay? Do you understand it? Now, this profit or loss and comprehensive income is like, it's just like one. Okay? It's like one, but you know, somehow if you want to get the picture properly, you separate it. Okay? You know, I told you it used to be trading. The name for it before used to be trading, profit and loss account. So the statement of profit or loss account and comprehensive income, they are somehow joined together. So don't get confused with that. When we begin to solve the question, you understand. So when a bad debt is recorded on the trial balance, you just treat it as expense. It doesn't appear in the financial position. But when you have additional information about bad debt, okay, when you have information about bad debt in the footnote, then it's going to appear as expense, and it's going to affect the receivable account in the financial position. Do you understand? So it's appearing two places now. Okay. Now we have provisions, bad debt and doubtful debt. Provision for bad debts, bad or doubtful debt. Now, when you notice that, this is how it works. When you notice that a certain customer, okay, is likely not to pay you due to maybe the customer, you just notice that with the way things are going, he might not give you your full money, or he might not pay you at all. Okay, you make provisions for it. It's just that you don't have a certain amount in mind, and you don't have the dates in which it's going to default in mind, because already you have your period of financial statements. Okay, you have, so from this period to this period, but actually you don't know when it's going to default, and you don't have the actual amount in mind. Are you with me? So you make a provision, just like 50-50 chance. You make a provision. If he pays you, fine. If he doesn't pay you, your provision covers for that. So provision for bad or doubtful debt is treated as an expense, okay, in the statement of comprehensive income, and in the financial position, it's going to affect the debtor's account. It's going to affect the debtor's account. We are going to see that in detail, okay. Then for discount on receivable, provision for discount on receivable is the same scenario for doubtful debt, but it's quite different. It's almost the same. It's just that this one now, discount on receivable, you know, just like we treated the cash book, if you could remember, we said we have a column for discount allowed. When you say you just want to encourage a customer, a debtor, to pay you your debt. So you say, okay, Oga, if you can pay me, or if you can give me my money within so time and so time, you're going to enjoy 10% discount. Okay, that's the provision we are doing here. So that discount now is an expense. When you allow discount, is an expense. Okay, so you allow for it. Okay, you allow for it so that your figures, your statement of financial positions is going to be, your figures are going to be accurate. So when you make provisions for it, it's going to be, or it's going to affect your debtors account in the financial position, and it's going to be what? It's going to be your it's going to appear under expense in your statement of profit or loss account. Okay, it's going to be an expense. That is provision for on receivable. When we say discount on payables, now this is how it works. Your examiner, they are not likely to ask you a question on discount on payable, because when we say discount on payables, provision for discount on payables, these are discounts you enjoyed from your suppliers, from people that you buy from. Okay, now discount on payable cannot be guaranteed except your creditors are paid within a specified period of time. Remember, your debtors or your customers that enjoy discount from you, you gave them a deadline, or you gave them a specific period of time. Say, Oga, if you can pay up your debts within this period of time, you are going to enjoy discount. Now, if you as a business owner, the terms and conditions or the agreed dates reached by your creditors, you were not able to pay them, you can't enjoy discount. You only enjoy discounts when you pay them within an agreed period of time. Do you understand? So if you don't pay them within that period of time, you cannot enjoy discounts received. Cannot enjoy discount. So by doing that, when you make provision for that, it may inflate your statements of your entries in your statements. Okay, so examiners are not likely to ask you question on discount on provision for discount on payable, and which is against the prudent standard of accounting. Do you understand? Okay, so that's that. So we will understand more when we begin to solve questions on that. Then lastly, we have depreciation. Okay. Now, depreciation, provision for depreciation. You know, for plants and machinery, machines or equipment you use in working, you use for your business, you are supposed to set aside some amount of money to cover up for the used life of those equipments and machines. It's called provisions. You have to make provisions for them. Now, provision on depreciation or depreciation itself is a whole topic on its own. Subsequent class, we are going to treat depreciation in full, okay? But for the purpose of this adjustment, let's just understand what the provision for depreciation is. There are various methods of depreciation. There are various methods of depreciation. But for this class, we are going to be working with the straight line method and the reducing balance method. Straight line method and the reducing balance method. There are other methods. When we begin to solve or deal with depreciation in full, we are going to see other methods, okay? So just like I said, when we say provision for depreciation is a certain amount kept aside to cover up for the useful life or to cover up for the life used of the machine in the normal course of business, okay? We are going to see how that works when treating a question. Now, okay, I think we have covered all. So what we're going to do is, I need you to use the comment section, ask me any question on these subtopics we have just on this adjustment. Remember I told you a trick is this or a clue is this. All these adjustments, as long as you see them on the footnotes or additional information, they must appear twice in the books of the final account of a sole trader. They must appear in 2 places. Do you understand? Okay, I don't want the class to be too long. In the next class, we are going to see solve a comprehensive question. And when we start, I need you to be very attentive when we start solving that question, okay? All right, click the notification bell so that you get notified when that class drops, okay? Please subscribe if you have not done so. Invite people to be part of what we're doing. Share and comment. Anywhere you don't understand, you can reach out to us, okay? All right, thank you for staying to the end of the class. See you in the next class.